So let's talk about Verizon, and we can take another example, right? I'm talking Verizon because I'm evaluating it right now, right? It's dropping. And so if you look at my recommendation, $140, right? Makes sense, right? And I'm not gonna go with the recommend. I'm saying that that's the right recommendation. Actually, it's much better than that. So I'm just gonna show this quick example, right? So if you look at it, right, like the cash flow operating has grown at 4% CAGR for the last 9 years. Correct? Is that correct? Right? And I don't know if you know, like Verizon is buying its stock every year, and so the number of shares are dropping by 4%, right? It's compounding, right? So basically, overall, the stock price will go by 8%. Does it make sense? Why? Everyone, like 5 plus 4, 9. Sorry, 9%. Does it make sense? Why? So there's a 9% growth rate, right? Inherently, right? And if you look at, um, let's say this, right? So here's why I'm trying to tell you, right? So this is the cash flow they are making, right? This is the cash flow they are making, right? And look at all that cash flow is going in buying shares. Do you see that? They are just consecutively buying shares and shares, right? So their stock count went from 0.17 to 0.11. So they are like a. Is everyone able to see those numbers? Sorry, I'm just trying to increase it. Is that good?
Does this happen, Chandanji?
Yeah, I'm just trying to take an example of a stock where the company knows its underwriters is buying its shares every year, right?
Why would they do that?
You need to read 10K for that. But what I'm just trying to tell an example where you can figure out the future growth of the company just by looking at what's happening, right? So they are earning 4% every year, and they are taking away the stock, right? So stock is dropped. They are removing the stock from the market. So basically, you can have like a nine and the way so they are guaranteed to generate 5% return growth every year. And if they drop the share count by 4%, that means you're gonna get a 9% CAGR regardless. Now the only thing is, when do you buy? That's a separate question we talk about, right? Does that make sense to everyone? So
Yes.
all their cash flow is going in buying capital, buying stocks. That's it. And their profit margins are huge. It's like 60%. Do you see that? And they have very low capex. They don't need any capex. If you know Verizon, you'll know understand why it doesn't need any capex. So everything is like free cash flow. And so that's why my analysis doesn't come at 140. It should like come at 180, 190, which is the current price. Because if you do 4% compounding, it will come to the median price. Anyways, so that's something I wanted to share. Again, if you look at this, like look at this company, right? See, it's growing revenues. Do you see that? It's just growing revenues, right? Cash flows are also going similarly, right? So those are the companies you want to look at, right?